Yep.
Does that? I'm trying to figure out what is causing
yeah, that looks fine.
thing, though. That's
Thank you very much.
Okay. All right.
okay.
Okay. Okay, all set now?
Good on my end.
Hi. Can we start here? Okay, let's get started then. Good morning, ladies and gentlemen. Welcome to this very special webinar hosted jointly by Institute for Global Economics and Chosunilbo, Korea's leading newspaper this morning. Today, I'm so very excited with a truly outstanding guest speaker, Mr. Bryan Brooks, who commands exceptional respect from the international financial community, especially on issues relating to crypto finance. He has been widely recognized as one of the visionary global leaders in the area of financial service, fintech, crypto assets, and blockchain. I'm confident that his insightful views will help us understand the recent and prospective trends of crypto finance, especially in the context of the US SEC's authorization of spot Bitcoin ETFs earlier this month. Bryan is uniquely qualified to shed lights on topics of cryptos from perspectives of both regulator and investor. Now, first, before we get started, let me briefly introduce our speaker. Dr. Brooks is an American lawyer, banker, entrepreneur, and government official. He served as acting controller of the currency, supervising U.S. national banking system, as well as a board member of FDIC during the Trump administration. He had also served as executive VP of 3.2 trillion Fannie Mae and chief legal officer of Coinbase, which is one of the largest digital currency platforms in the world. Most recently, he was CEO of Binance USA, the global leading crypto exchange, and he's been advising a number of prominent investment houses around the world. He is an honors graduate of Harvard University and the University of Chicago Law School. Now, without further ado, let's welcome Dr. Brooks. Bryan, good to see you again. Thank you very much for joining us live from, as I understand it, Los Angeles, actually live from your car on the way to the airport as our special guest speaker. Now, I would like to carry out our conversation as a fireside chat without fire until 11 a.m. In Seoul time or 6 p.m. I think your time. That's about it, right? Okay, are you ready? All set?
I am ready, and thanks so much for having me, Dr. June. It's always a pleasure.
Okay, great. Now, I would like to start with the significance of US SEC's recent authorization of a spot Bitcoin ETF. So my first question to you is broad and more sort of as a sort of introductory question to our conversation today. That is that how significant or momentous is the recent launching of the spot Bitcoin ETF for crypto finance and investment opportunities in the future. How about its implications for broader asset management and financial services industries as well?
So there's a lot to unpack there. Let me start with the simplest respect in which this is an important event, and I'll try and broaden it to asset management more generally. So the simplest way to think about the Bitcoin ETF is this is Bitcoin's IPO. Okay, this is Bitcoin's going public. And that really matters because Bitcoin has gotten to be a $1 trillion asset in a world where mutual funds and retirement funds around the world were not legally allowed to hold it. So just imagine what that would look like in a world where pension funds, asset managers like BlackRock, mutual fund sponsors and retirement sponsors like Fidelity are able to offer it very broadly. That would imply that instead of being a $1 trillion asset, Bitcoin in its maturity could be a $10 trillion asset, right? Because it's only been held by hobbyists and deep believers until now, and now it will be actually a broader asset class. So that's the first thing I think about. But what I think is maybe even more important than that is that while the first spot ETF in crypto is for Bitcoin, it's not likely to be the last spot ETF. So there's already a plan in the works for an Ethereum exchange-traded product. And after that, there will certainly be many other exchange-traded products in the crypto area, including index products. So that would tend to suggest that this is not only about Bitcoin, this is really the IPO of cryptocurrency generally. And that implies much more than just a growth in this one asset. What it implies is an acceptance by the largest institutional asset managers in the world that blockchain assets are as legitimate of assets as are derivatives or even as are public equities. And when you think about what that could do to diversify portfolios and give investors a source of volatility to speculate on, it's hard to overstate what a big event this is.
Yeah, that's great. I think your point of it's like IPO of blockchain assets. I think extremely well said. I think that says very clearly about what it means to us. Now, relating to this issue has to do with the price trend of Bitcoin over the last 2 or 3 weeks. Now, from the beginning, I don't know whether there was a right perception or not, but there was a general expectation that following the authorization of Bitcoin ETF, spot Bitcoin ETF, price of Bitcoin will go up. But contrary to that expectation, at least up until a day or two ago, it's been down consistently. Now, how should we interpret or understand this sort of trend? Are there any unique pricing mechanisms applicable to this Bitcoin pricing between spot and futures?
Yeah, well, so there's the issue of spot versus futures, and then there's the issue of why did the price go down, and what can we expect in the medium term about future price performance. So let me talk about both of those things in turn. So on the futures versus spot issue, in a perfect world, futures would accurately predict a later point in time along the price spectrum. So we've had a futures Bitcoin ETF in the US for quite a while. I mean, a couple of years or even more at this point. And so the introduction of a spot Bitcoin ETF simply means that instead of having the latency effects of a futures market, which is predictive, but it's imperfectly predictive, we will now have an institutional way to actually own the underlying asset. You see this in other commodity markets, by the way, where orange juice futures prices or crude oil futures prices are good predictors of the future price in the spot market, but they're not perfect predictors. And so the point of the spot market is to give you a real-time set of information, and in that sense, it's naturally better, especially for retail investors. But speaking to your bigger issue of how come the price fell, I come back to my IPO metaphor. So Bitcoin is basically a tech stock. So let's think about Bitcoin as a technology, and the blockchain is a technology, and the Bitcoin is the asset that represents an ownership stake in that technology. And so if you go back and you look at the IPO of Google or Facebook or a number of others, I've looked at a number of examples of this. Coinbase maybe is even the best example in their IPO 2 years ago. What happened in those IPOs is those stocks went public at a high valuation, and not just immediately after, but often for 6 months after, those stocks traded down. So, for example, Facebook traded dramatically down, 40 and 50% off of their opening. So did Coinbase. But eventually, those stocks generally recovered. And if you look at Facebook as an example, have now far exceeded their IPO price, even though there was a 6-month sell-off. The reason for the sell-off typically is that you have a certain number of people who are kind of price takers. And the idea is they're looking for liquidity. So they bought Bitcoin when it was $10. Now there's a chance to sell Bitcoin at $40,000, and they're happy to take their money off the table at 40. Peak was higher than that, right? And those people are selling into the IPO. The question is, will the price meaningfully come back? And as you say, it's already started to come back. So today the price was around 43,000, whereas it was trading as low as 39,000 just a week ago. Here's, however, the way that Bitcoin is different from other kinds of IPOs. This asset was never publicly available before. Okay. It was only available to people willing to have a Coinbase account or whatever, but it wasn't open to retirement savers, pension plans, asset managers, index providers. There was no alternative. Versus when Facebook went public, there were other tech stocks you could invest in, but there's never been a cryptocurrency that was publicly available until now. That means, as I said a minute ago, that the demand for Bitcoin is secularly higher. Now it will not only be held by individuals, but it will be held inside of retirement plans, pensions, and the like. So that's roughly a 10x increase in demand. At the same time, what some of your listeners may not be aware of is Bitcoin periodically has a supply reduction that's built into its code. We call this the halving, where roughly every 4 years or so, the amount of new Bitcoin released into the system is released by 50%. That halving of supply is going to occur in just 2.5 months in mid-April of this year. So the combination of the 10x increase in demand, coupled with the halving of supply, inevitably will raise the price. Now, I don't have a view on what the price exactly will be 6 months to a year from now, but any student of economics knows that when supply is decreased and demand is increased, price will rise on a predictable basis. And that's what I would expect to happen here, notwithstanding the sell-off right after the IPO.
Okay. Thank you very much. Your IPO metaphor explains a lot about the pricing behavior after IPO, as in the case other tech stocks or even with the Bitcoin. So it was again, I would like to say that that was very well said for better understanding on our part. Now, you have already said something about the future, whether that's 6 months or 1 year later. Broadly, you're expecting growing market value of this Bitcoin. Would you say something about how differently different coins, cryptos, Bitcoin, Ethereum, they're different, obviously, from other so-called altcoins, stable coins. Now, from the investor perspective, what sort of precaution or preference they better have in dealing with the different sort of characteristics of different cryptos?
Yeah, so this is a great question, and I'm really excited to have the opportunity to talk about this because, I think many people believe that all tokens are fungible, so they're basically just coins, and you can buy whichever one is cheapest. So let me try and dispel that myth. The way that I describe the crypto ecosystem to people who are relatively new to the industry is there are basically 4 things going on in crypto. This is just a simple mental model for thinking about crypto. One of the 4 things, the first thing is Bitcoin. Bitcoin is unique in the crypto ecosystem, and it's particularly unique in its rationing characteristic. So remember I mentioned a moment ago that the amount of new supply released in the system is cut in half every 4 years. What that means is Bitcoin serves one basic function in the economy, and that is it is sound monetary policy. Now, you and I, Dr. June, have both had various relationships with our country's central banks, and we understand monetary policy in the way that you can have an inflationary currency or a deflationary currency depending on the policy choices that our central bank governors make. In Bitcoin, the monetary policy choice has already been made. Okay, Bitcoin is like the gold standard. There will never be any more of it, and the rate at which it will be released is going to reduce over time. So the point of Bitcoin is to be sound money. It's very similar to buying a hedge against future inflation expectations. And the way to think about it is typically when the market expects a looser monetary policy, the price of Bitcoin goes up. So think about its current price rise. One of the factors going in is a belief that central bankers have tamed inflation and are now going to start loosening policy, which will create more inflation in the future, and Bitcoin will rise in anticipation of that. Versus when central bankers announce a tightening policy, on the front end of that announcement, Bitcoin typically falls in value because the need for a hedge against inflation is less, right, in a tightening environment. That's what Bitcoin is. It is a hedge against inflation. We refer to it sometimes as digital gold, and that's one of the four things going on in crypto. The second thing in crypto relates to a group of tokens that we call smart contract platforms. Okay, and there's 7 or 8 of these out there in the world. Ethereum, which you mentioned, is the biggest and most well known of them, but there are a number of others, including Solana, Avalanche, Cardano, and several others that some of our listeners might have heard about. The point of these 7 or 8 smart contract protocols and the tokens that power them is to create a service for automated financial services. So the idea of smart contracts is in the future, we won't necessarily need central credit administrators or record, ledger keepers, depository institutions, because all of those functions that banks perform today could be fully automated in a decentralized way. And the tokens, like the Ethereum token, represent investments in those underlying protocols. So it's almost like if you're a shareholder in JP Morgan and you believe that in the future these smart contract protocols will take over the banking business, in the future you might, instead of being a JP Morgan investor, you might want to be an Ethereum investor. Okay, so the simple mental model for these smart contract platforms is it's fully automated financial services for the future. Now, which of those platforms will win is anybody's guess. And the tech investors on the call will remember the browser wars of the 1990s when nobody could be sure whether Netscape or Yahoo or AltaVista or Google would win. But if you were buying stock in one of those companies, you were betting that was going to be the winner. Now, in the end, Google was the winner. But once upon a time, there was a competition. Same thing with smart contracts. We don't yet know whether Ethereum or Avalanche or some other protocol will eventually be the platform of choice for decentralized finance, but one or two of them will. And those ones will be the ones that have long-term permanent value creation. So that's the second thing going on in crypto, which is, financial services, smart contracts. The third thing in crypto that everyone needs to understand is stable coins, which you just mentioned. Now, stable coins themselves are not their own blockchains. Stable coins are crypto assets that are built on top of pre-existing blockchains, generally one of these smart contracts that I've just spoken about. But stablecoins are very, very powerful because they're the next innovation in savings and payment products. I'll just talk about one key use of this in a way that I think everyone on the call will understand, and that is one of the things that gives the United States soft power in the world is the wide acceptance of the dollar in global commodities markets. But as you know, retail holders in most countries are not able to easily access dollar savings accounts or dollar payment accounts. So for example, if you live in Argentina, you can't just walk into a local bank branch and say that you'd like to hold your wealth in dollars. The Argentine national currency is the peso. The peso is a highly, highly inflationary asset, and yet you can't go to your local bank and say, I'd rather hold dollars than pesos. So you're at this inflation risk. Enter stablecoins. Stablecoins make it possible for people in any country in the world to hold dollar equivalents by holding a dollar stablecoin, which is redeemable for dollars inside of your crypto wallet. And so one of the killer apps of crypto is the ability to offer a given currency in a country where that currency is not supported by the banking system. So dollars are the most attractive currency, followed by euros, followed by yen, followed by sterling, or whatever your ranking is of those currencies. Stablecoins make those things universally available, and they tend to mitigate against bad monetary policy in countries that are running an inflation approach to money. That's the third thing, okay, stablecoins, the ability to have any currency in any country. And then the fourth thing in crypto is everything else. And a lot of the other things in crypto don't necessarily have long-term value. They're meme tokens like Dogecoin, or they're scams like Celsius or Terra Luna or whatever. And what I would encourage people to think about is treat those tokens like internet stocks and ask yourself, do you understand enough about the underlying platform being built to invest in it the way that an equity investor would invest, which is looking at adoption, looking at revenues, looking at management team and the like. And if you don't understand those things with a given crypto project, you should probably stay away from it. But I think I've described the three clearly valuable crypto activities. As for the rest, you're looking for needles in haystacks. There may be some that have value. There may be many that don't. And again, if you think about it like internet stocks, then you need to do your diligence before you make an investment.
Okay, thank you very much for very useful tutorial service for many of us who do not really have a good deep understanding of different kind of coins. Appreciate that very much. Now, perhaps at this time I may ask you a rather personal, but not exactly personal question. That is that if we look at your exceptional career throughout your life, short life actually, shorter than mine, age-wise, but you were in the government as a top regulator. And also, you have been active in the industry, this crypto business, Binance and Coinbase, those. It's rather unusual credentials you have accumulated over the years. Now, I was always curious about what motivated you. You, someone who with exceptional public sort of credentials, a public official, high, very senior government officials, and also very distinguished educational backgrounds. I don't know, I may be biased, but I thought that was somewhat a sort of different track if you move to a very innovative, very new area of this crypto field, blockchain areas. So I'm curious, and perhaps you could share your personal sort of thought on why you got into this crypto finance from the beginning.
Well, I never shy away from a chance to talk about myself, so I'm happy to tell my story a little bit. And the way that I think about this is, for a very long time in this country, in the United States, the story of finance was the story of both technology innovation and financial innovation. I'll just give you a couple of examples. So on the technology side, for the longest time, banks were brick and mortar operations. And, if you wanted to either deposit money, withdraw money, or take out a loan, you would have to visit a bank branch and you'd have to meet with a bank employee who would decide whether you were eligible for that product. And that was true for a long time, for 100 years. And then starting in the 1960s, some of those things started being automated with, first rudimentary technology and then more interesting technology. So, for an example, at a certain point, American banks introduced the concept of the drive-through window that might be open when the branch was closed. They would have these little pneumatic tubes, and you would, if you wanted to make a withdrawal, you'd fill out a withdrawal slip. and you'd put the little plastic thing in the pneumatic tube, and it would go inside the branch and come back and give you your money. And a little bit later, we invented the concept of the automated teller machine, which was open 24 hours a day. And now you could deposit and withdraw money at the bank, even on a Saturday afternoon or even late at night. And that was a major technology innovation. Then we had phone banking. You could dial up on your phone and you could check your balance by entering a code without ever going to the bank at all. You wouldn't have to physically go anywhere. Then we got credit and debit cards. And these cards allowed you to do amazing things that you couldn't do earlier. My point being, there were all kinds of technology innovations that at the time people accepted as a natural evolution of the system. Somehow, in the last 20 years, that spirit of innovation in finance has changed, and regulators changed with it. So whereas people who held my job in America in the 50s, 60s, and 70s, even the 80s really, saw their job as consistently pushing finance to modernize and to keep pace with modern technology, all of a sudden in the last 20 years, that mindset shifted so that we would become protectors of incumbents. And that happened when we decided we didn't want commercial companies to hold bank charters. And it happened when we decided that financial technology companies should not affiliate with banks. And it's happening with crypto as well. Crypto is just the next technology iteration of financial services. But somehow we see it as different from the ATM. It's different from credit cards. It's different from these other things. I would just tell you that in my whole career, I've tried to be right at the forefront of whatever the newest thing was, because whoever is first to capture the newest thing generally is the most successful. And that was my vision of crypto, is it's just the next iteration of how people will transact with each other. And frankly, the fact that you and I are on this call, you're sitting in Seoul, I'm sitting in Los Angeles, this call would have been unthinkable even 10 years ago, right? Crypto is just a version of what you and I are doing right now. We're using a technology to video conference with people all around the world in real time. And crypto offers the promise of us being able to transact with each other across the world in real time without worrying about the fact that you transact in won and I transact in dollars, without worrying about the fact that for you it's early in the morning and for me it's late in the evening. Those things to me should be natural. And I see one of my missions, and this is why I so appreciate your invitations over the years, is my mission is to demystify this. It's to say that crypto is not a secret get-rich-quick scheme. It's not some magical new form of wealth creation.
No.
It's just a radically modern approach to two people transacting with each other.
That's extremely enlightening statement that you just made. Very much appreciate that, and I think you are opening up our eyes for this radically, very quickly changing technological environment we have in the financial services business and asset management field as well. So I think I'm finding this communication extremely helpful for all of us to have better understanding of what's really driving this change. Appreciate it very much, as usual, Brian. Now, speaking of the enormous strength, if you like, or resilience that cryptos have demonstrated over the years. Now, I'm referring to one of the interesting articles that I saw recently on Economist. I'm not sure whether, Brian, you're so busy, so whether you had time to look at it.
But I always read The Economist.
Okay. There was something like cockroach theory of cryptos. Have you seen it?
I have seen it.
Okay. Now, what this says is that they're trying to explain why these cryptos are so very resilient, over the last decades. Now, at one point, there was almost a consensus that it's gone. The crypto business is completely, is out of fashion it at some point because it doesn't really have intrinsic value and is too volatile. But all of a sudden, they have revived themselves. If you look at the history of these cryptos, now, so exceptional survivability, if you like. Where's that from? Now, what's driving this cryptos, this unusual capability?
So it's a great question. There's a lot to unpack there, but let me begin by challenging the premise a little bit. So everyone always talks about how it's so volatile and it almost blew up. It almost went to zero. This is what people say, and many people believe this. And so I think a lot of people on this call will be surprised to learn that in the 15 years that Bitcoin has been around, in something like 12 of those 15 years, Bitcoin has been the best performing asset class of all asset classes. Okay, in 12 of the 15 years. Last year, Bitcoin outperformed the S&P 500 by approximately 500%. And that's been true many years. So, when people tell me, oh my God, Bitcoin almost died, what I remember is when I still worked at Coinbase, I was traveling at a certain point. This was around December of 2018, I want to say, when Bitcoin was at 3,000. And there was a headline in Business Week that I saw in the airport newsstand. Okay, so I think the English speakers on this call will at least get this reference. The headline said, "Rhymes with Bitcoin, has crypto hit the fan?" That was when Bitcoin was at 3,000. It's now at 43,000. And when it's at 43,000, people are still talking about whether it's almost gone to zero. So, yes, it's an up and down ride, but the long-term direction is always up. I will tell you parenthetically, the value of the dollar is not up. The value of the dollar is always down, right? Now, sometimes it's down 2% and sometimes it's down 9% in terms of its purchasing power. But fiat currency always goes down, whereas Bitcoin has generally only gone up over time. So I think that's the first thing I would say. In terms of its resilience, I think there have been a handful of tailwinds for crypto generally. On the Bitcoin side, profligate monetary policy around the world has been very, very good for Bitcoin, right? Bitcoin is rationed money versus fiat currency is not rationed money. Fiat currency is printed money at the whim of whatever you want to say about central bank independence, political leadership. So the fact that Bitcoin is scarce is good in a high inflation environment. And we've had that now for a number of years. For the other cryptos, as I said earlier, they're mostly about creating networks for decentralized finance. That's what all of the smart contract platforms are about. And what you learned in the 90s and early 2000s with the growth of the internet is networks always win. So if you have two ways of delivering a service, one is on a centralized basis like a bank, and the other is on a networked basis like blockchain, over time the network will always win because networks, are inherently resilient. A number of nodes on a network can fail and the network can still function. Versus if the bank closes and you can't do business with the bank. You saw this a couple of years ago when the FedWire system in the United States went down for 7 hours and all payments globally came to a halt for 7 hours. That doesn't happen with blockchains because blockchains are maintained by thousands and thousands of nodes, and so they have a resilience that non-network things didn't have. My analogy for this, by the way, is if you think about the way that brick and mortar retail used to work before Amazon, every country and every major city had its own local department stores that did very well. There was Macy's in New York and Marshall Field in Chicago and I. Magnin in San Francisco. But once a networked approach to retail happened, once Amazon achieved scale, all of those businesses went out of business. They all went bankrupt, save only for Macy's, which bought a lot of those firms out of bankruptcy. So my question is, why would we think that networks would win in commerce, but they wouldn't win in financial services? And I can't think of a reason why that would be. So it's really those things. It's the network effects of crypto coupled with the monetary policy of Bitcoin that makes these ultimately very attractive assets, much as the incumbents might not like that. But that's a very predictable outcome to me.
Yeah, that's great. Great. Since you have touched upon monetary policy, central bank, and this dollar movement, perhaps this may be a good time to ask, where do you stand on CBDC, central bank digital currency? Quite a few countries have been looking into this possibility, and some others ahead, and some others following. And the latest story that I gather is that UK, a British government, Bank of England, is contemplating this digital pound idea lately. Now, tell us where we stand on this and how this will likely move forward, and also please tell us CBDC eventually. CBDC represents a competition to cryptos, or complementary to crypto markets?
So that's a great question. So first of all, for the neophytes on the call, I will say that when governments talk about CBDCs, often what they're really doing is they're conflating the idea of currencies with the idea of a real-time payments system. And so the thinking is, in a world of fiat currency where you're processing checks, or you're engaging in messaging applications like Venmo or Zelle, or any of those applications, generally speaking, what you're trying to solve is the problem of latency, of slow settlement, where there's a time lag between the time I send you money and the time the money finally settles at the central bank. And fixing the real-time payments problem is something governments should do. That's a good and worthy exercise in my judgment. Where I get off the bus, and what I worry about very much, is the idea that, hey, in addition to a payments settlement system, which the government can provide through the central bank, we're literally going to change the nature of currency and the role that banks play in intermediating between the central bank, which creates currency, and consumers who use and spend currency. What worries me about that is, if the government is literally issuing the currency itself, which at the moment is issued through banks, not the central bank, right, but through banks, the government has the ability to dictate how those dollars or yuan or whatever currency we're talking about ultimately transact. And I think that governments have a real, and to my way of thinking, a dangerous history of trying to control people through their spending habits that is not consistent with the kind of freedoms that most people in the developed world are used to. So the example I always give, which is an easy example, but it's a very real example, is what happened during the Canadian trucker protest during the COVID pandemic. So you may remember that a group of Canadian truckers were upset about the fact that Canada would not let them enter the country, even though they were Canadian nationals, without stopping at the border and taking a COVID test, which was incredibly intrusive and delayed their. I mean, it just created traffic jams. It was difficult for the truckers in all kinds of ways. So at a certain point, they exercised their political right to protest, and they organized and they parked their trucks at an important bridge crossing between the U.S. and Canada until the Canadian government, would listen to their demands. Rather than listening to their demands, the Canadian government figured out a way to block their access to their own bank accounts. So just imagine this: you've worked at a job to earn money, you've paid taxes on your money, you've deposited the money in a bank. So it's yours, right? I mean, you've earned it, saved it, paid taxes on it, and now it's yours. And imagine that the government is able to block you from withdrawing your own money to buy lunch, okay, or to pay your kid's school tuition, because you're engaged in political speech that the current administration and the government doesn't support. That's a scary prospect, and that can happen even in the current banking system. So imagine a world where it could happen at any time to any of us, okay? Imagine a world where the government could monitor all of your transactions and say, you know what, Mr. Brooks, you've bought too much gasoline this month, and our climate goals call for less gasoline consumption. So we're now turning off your credit card and you can't buy any more gasoline until next month. Or imagine it said, Mr. Brooks, you've bought too many high-calorie foods at the grocery store, and that imposes a healthcare burden on our health system. So we're turning off your card, and you can't spend your central bank digital currency at the grocery store until next month. These are all very real things, some of which have been overtly discussed by proponents of CBDCs, which again, to me, are not consistent with the freedoms that we all enjoy in the developed world. I then turn to this question, which is, what problem are we trying to solve? There are already scaled stablecoins that transact instantly, that provide real-time settlement, just like CBDCs are supposed to, except they're not in the control of the government, and so they don't present the liberty challenges that I'm talking about. So the Tether stablecoin, the USDC stablecoin, the PayPal stablecoin. If those are achieving wide acceptance and adoption, why do we need the government to build something? And so I'll just close with this thought, okay? And different people of different ideologies may have a different view. But I come back to the fact that you and I are talking on these devices, right? We're on this video conference, and I'm on a phone that was designed by Apple pursuant to a set of Federal Communications Commission government guidelines, right? Emissions guidelines and some other design parameters. What I always say is, it is an appropriate use of government power to set the cellular telephony standards, the wireless standards. I don't want my phone interfering with the phone of the driver that's driving by me right now. But do I want the government to build my phone? And if the government did build my phone, would we expect that the government would build in features like Zoom, or features like Amazon, or features like Signal text messaging? I'm not so sure that they would. So my belief is that design parameters, supply and demand, those kinds of things should be done by private actors, not just to preserve personal liberty, but also because the kinds of things we want are more likely to be determined by markets than by government command and control. I think the role of the government is to establish parameters for when is a transaction settled, who has to accept a currency and the like. But building the actual platform for value transmission like a CBDC, I worry about that very much. And I'm on record again and again as saying I don't think that's the right approach.
Okay, got the point. Speaking of role of government, perhaps I may ask you to share your insights, views about how best regulators carry out their responsibilities to ensure market stability and investor protection in these crypto markets. As you may know, you would know, the Korean investors, especially individual investors, have been very active in these crypto markets, as well as in capital markets broadly. Now, in this situation, regulatory authorities have legitimate concerns about moving too much into a new innovative field of investment like cryptos in Korea, because already Korea represents a big chunk of the crypto trading around the world. So what would you suggest, what your advice on how best regulatory authorities should take to preserve this stability, at the same time promote innovation? It's always difficult to strike a balance between those two, but your wisdom that I would like to borrow.
Well. So look, I always start with first principles, okay? And one of my first principles as a former regulator is that regulators should be demand neutral. So when we talk about investor protection or consumer protection, I don't think what that means is that there shouldn't be risk in the system or that people should be protected from their own informed choices. So, for example, it's one of the reasons why I've never been in favor of banning tobacco. Tobacco is generally bad for you, but on the other hand, it provides a certain amount of pleasure and social interaction with people. And if we fully disclose the risks, and knowing all of the risks, an adult decides that they want to smoke a cigarette, I'm okay with that in a free society. Now, you could argue that if the only value that mattered was health and safety, we would ban tobacco. But we have broadly in the developed world not chosen to do that. And so when I think about financial regulation, what I worry about a little bit is there is this tenor of, well, you might lose money with Bitcoin, and therefore you shouldn't be allowed to invest in Bitcoin. And I think about that, and I think, well, there are lots of public equities that people have lost money in, and it's not because the equity was a scam. It was because, some people believed that, Netscape was going to win instead of Google, and it might have. And it's not investor protection to say you can't invest in a money-losing proposition, as long as there's full disclosure of who the management team is, what the risks are, et cetera, et cetera. That's my first principle. So having said all of that, I think that right now, not in the whole world, but in much of the world, certainly in the US, there is a belief that investor protection means we need less crypto investing. And to be honest, I don't know if we need less crypto investing or more crypto investing. But what I do know is there's a widespread demand for a wide variety of crypto assets. And generally speaking, if you ask those investors ex ante, they're angered by the fact that the government has made it harder for them to acquire those assets than it needs to be. So if one of the purposes of financial regulation is capital formation, appropriate risk balancing between, opportunity cost and upside cost and those kinds of things, then what you do is you'd focus on disclosures, you would focus on fraud prevention, you'd focus on security, but you wouldn't make value judgments that this is good for the world or bad for the world. In the same way, by the way, that I don't think the government should tell people that we need electric vehicles instead of gas-powered vehicles. I think that if we let price signals work, and if we disclose to people the pros and cons of all of those things, there's an equilibrium that will arise where the people who want EVs will get them and the people who want gas vehicles will get those. And it's the same thing with crypto. Some people believe that Google will win and Bitcoin will not win. Some people believe that the dollar will win and stable coins will not win. And both sides of that trade should be able to make investments in an environment of full disclosure and risk management.
That's brilliantly said. Appreciate that very much, as usual, Brian. Now, we have about 10 minutes to go. I hope you're not losing your plane at the airport. Is that okay? You have 10 minutes?
This is all perfect. I've waited out the traffic, so now it's going to be easier to get to the airplane than it would have been when we started this. So thank you for the favor.
Okay. All right. Now, despite all those potential sort of positive attributes as part of whole portfolios and so forth, as part of also a facilitator for financial innovation. But still, we hear quite often that there's some illegitimate or illegal activities involved in this crypto-related activities, like money laundering, illegal use of uses of cryptos and so forth. How best we can sort of protect from those this illegitimate activities? Is there any better way or best way to deal with this?
Well, yeah. So let me distinguish between two kinds of things here. So there are people who are committing fraud in crypto. So this would be the Sam Bankman-Fried type of example, or the Celsius, the Terra Luna, where the crypto project itself was fraudulent in some way and people were being fleeced. And that happens a certain amount of the time in crypto, as it does in other areas of finance. There are Bernie Madoffs and there are Sam Bankman-Frieds, and they're not materially different, despite the fact that Bernie Madoff used the banking system and Sam Bankman-Fried used crypto. That's just fraud, okay? And there's a certain amount of that. But then there's the broader issue of people who are choosing to use crypto assets instead of fiat currency to perpetrate some sort of bad act. It could be terrorism financing. It could be money laundering. It could be a whole set of issues. What I would tell you here is, here is where there's a lot of you know, a lot of misunderstanding, I would say, about what really goes on inside of crypto. So, for instance, the most recent thing you've heard a lot about is this idea that perhaps the Hamas terrorists were funding themselves using Bitcoin contributions
No.
to finance their attack on Israel and you know, their later defense of the war. The truth of the matter is, and I had an op-ed with the general counsel of a big crypto analytics platform just a couple months ago on this. The truth of the matter is that back in April of last year, Hamas stopped accepting Bitcoin donations. And the reason is because, contrary to popular belief, Bitcoin and most cryptocurrencies are not only not private, but they achieve their security because of how very public they are. So a distinction that you know, should be understood is, if I were to send you a personal check, or if I were to Venmo you money from my bank to your bank, that would be secret. Its disclosure would not be publicly available. The banks on both sides would be bound by legal obligations to keep that information secret. The bank transaction is very secret. Versus in blockchain transactions such as Bitcoin, the way security is achieved is not by maintaining secrecy. It is by a public ledger that has, you know, hundreds and thousands of copies on every computer that's connected to the network. So literally everyone knows that I sent Bitcoin to you. This is why, in fact, so many great cyber hacking cases have been solved because the bad guys, the hackers, asked for Bitcoin as ransom. And as soon as the ransom was paid, these analytics platforms, and their names your viewers may have heard about, like Chainalysis and Elliptic, for instance, were instantly able to say, oh my goodness, this wallet sent that wallet a Bitcoin, and that wallet belongs to Russian hackers. So, for example, in America a couple of years ago, when our major northeastern natural gas pipeline was shut down and held for ransom, you know, because the computer system that controlled it was hacked, the ransom was paid in Bitcoin, and within less than a day, we identified the Russian hacker group that had done this, and people were arrested. That wouldn't have happened had they demanded payment in gold bars or diamonds or cash. And that is why I say, you know, the use of crypto in criminal enterprises is much more limited than people think. And the last point I'll just make on this is, in the U.S., our Treasury Department releases a report every year about crime in the financial system. And for the last 10 years, they've addressed the level of crime that is being facilitated through crypto versus through the traditional banking system. And year in and year out, including in the most recent report, it talks about how, as a percentage, the percentage of Bitcoin transactions that are being used in illicit activity is far lower than the percentage of banking transactions that are, you know, represent illicit activity. So again, it all comes down to, people don't seem to understand that these assets are not private, they are not anonymous, and whatever you read to the contrary, it just ain't true.
Okay. All right. Thank you very much. Perhaps we have just one more question, looks like. Now, you have been a pioneer, not only in the area of cryptos, but also more broadly, DeFi's, decentralized finance field. And also, we have been the leader in the area of fintech. Also, if I remember correctly, you are the first head of controller of the currency who authorized fintech branches at U.S. banks. Yeah. So looking at bigger picture from now on, now with this institutionalized Bitcoin, or the development in cryptos and other digital platform finance area, we see continued innovations down the road. So how do you see the future shape of, say, financial group covering banking, asset management, investment banking, all those trading different sort of areas in, say, 10, 20 years? What sort of shape do you envision with all those changes taking place these days?
Well, so look, I think we have a policy choice in front of us, and
Mm,
which set of choices we make will dictate a lot about the future of money creation, the future of risk taking, and ultimately the future of growth, particularly in the developed world. So what I would say is we know that commercial banks alone uh, are both unable and to some extent unwilling to supply all of the credit needs of the economy. Why is that? Well, it's because the unit cost of small dollar lending, lending to people with lower credit scores, lending to people who don't speak the dominant language, is higher than the expected profit of allocating those credit dollars somewhere else, right? And banks have limited balance sheets. Even the biggest banks still have limited balance sheets, even though they may be large. And so those bank leadership teams have to decide, where shall I deploy the next dollar? If we make a choice to continue to reinforce the incumbency advantages of traditional banks, and we don't approve challenger banks, and we don't approve fintechs such as marketplace lenders, and we certainly don't approve crypto DeFi protocols, if we make that choice, then what will happen is we will continue to undersupply the broader economy, which means that we will not unleash the full productive power of the economy. It means that poor people, immigrants, minorities, and others will have relatively more limited access to capital, and the
mm,
full value of their talents will not be enjoyed by the broader society.
mm,
The reason that I mean, you asked me earlier about my career. The reason that I was ever interested in fintech and later became interested in crypto was precisely because the business model of those kinds of organizations was to
mm,
identify and serve pockets of the economy that aren't well served by incumbents. That's inherently a good thing, right? Marketplace lenders are looking for low FICO score borrowers who are nonetheless likely to repay their loans, but who banks won't serve because they're deemed too risky. And marketplace lenders, the largest of which I was a board member of for a long time, make it their business to reduce search costs, reduce borrowing costs, and find those people who do have a demand for credit and serve them when the banks won't do that. And that is a highly productive use of capital in a democracy.
mm.
Same thing with crypto. The whole point of crypto is in certain parts of the world, people's ability to participate in the economy is destroyed by inflation. In other parts of the world, it's destroyed by social policy, such as in China. You can't freely spend money if you're a Chinese national. And so crypto exists to, again, identify and serve those sectors that aren't well served by the traditional banking system. And as long as those gaps exist in the system, I'm going to believe that technology is the most likely solution. I'm in this for the growth. I'm in this for the belief that an economy that, is able to deliver the full productive power of all of its people is a better social outcome than an economy that only extracts the value of 70% of its people. And that's what fintech and crypto exist to solve.
Okay, excellent. Brian, thank you very much for sharing your exceptional insights, and you have enlightened us today, and you raised our understanding of cryptos and related issues immensely. I thank you once again very much, and I hope to see you very soon in person. Uh, any 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 plan to stop in Seoul uh,
Well,
this
I'm
year?
I'm gonna I'm gonna come and see you on purpose. So we're gonna make a plan together, and I'd love to
Okay,
meet many of your viewers in person. Let's make
let's
a plan.
work on that. Okay, great, and have a great flight from Los Angeles this evening over there. Once again, thank you very much on behalf of our audience. Thank you very much indeed. Yeah, Brian. Bye
My
now.
pleasure. Real honor to me. Cheers. Bye bye.
Yeah, bye.